Deloitte's 2021 Global Blockchain Survey. Reviewed by Mr. R. I can be found at misstep_. Disclaimer. Hello again, and thank you for joining. Of course, I'm not a financial advisor. This video is produced by myself as a way to document my own analysis of the current marketplace, reevaluating and building consensus around the positions I take in my own portfolio. Starting with Deloitte, this firm is known as one of the big four accounting firms in the world, the others being EY, KPMG, and PwC. Deloitte reported 40% of the revenues coming from advisory services. You must be aware of the reader they are aiming for, which is FSI and firms in the blockchain marketplace looking to forge partnerships or enter the FSI marketplace. FSIs are being impacted by the advancement of blockchain technology. The style I'll be using is an overview, followed by the colored sections in order, and they will be highlighted on screen. Objectives of the report: applications of CA, crypto assets, moving value, and the banking services. Opening statements. In the green, they have an overview of the time and the people who are part of this survey. They happen to occur during March to April of 2021, including 1,280 senior executives and practitioners in 10 different locations. Brazil 7%, Germany 12%, Hong Kong SAR 8%, Mainland China 28%, Japan 4%, Singapore 7%, South Africa 2%, UAE 3%, UK 9%, USA 33%. On screen now is a graph to help better understand the surveyed groups. You can see 960 are non-FSI, 250 are FSI, and 70 are FSI pioneers, a subgroup of FSI. Deloitte defines FSI pioneers as a group of people with their vision of blockchain and digital assets as a top 5 strategic priority. FSI pioneers have deep convictions about the potential of blockchain and digital assets in the future. They represent 5.4% of the overall survey group. Figure 2 on screen now, the future of digital assets. In the opening statement, they inform us with the following idea. I believe that digital assets will be very or somewhat important in my industry in the next 24 months. Creates an important opportunity for my bank and industries that hold assets. See digital assets and their underlying blockchain technology as a strategic priority now and in the future. The fact that nearly 80% of the overall respondents say that digital assets will be very/somewhat important to their respective industries. Here we can see the only time in the entire report 100% on a question by the FSI pioneers. With these percentages in mind, organizations increasingly accept that their current business models are at stake and will lose the opportunity of competitive advantage if they fail to adopt blockchain and/or digital assets. Disruption in financial services. Moving on to the next section, customers in the yellow FSI are nearly everyone, 5.6 billion people. For context, it is estimated that 2 billion people are unbanked. These individuals will have less barriers of entry for adopting crypto assets backed by blockchain technology, such as BTC or others. The parts in green and blue address payments and investing respectively. Payment providers such as PayPal, Visa, MasterCard are building relations with CA exchanges to offer credit cards or debit cards. Oddly, Amex has not made any partnerships, but allows their credit card to be used for payments on exchanges for crypto assets. Disruption in financial services. Now considering firms that are looking to allow investing to the masses would be Coinbase, Huobi, Nexo, Kraken, Binance, Gemini, BlockFi. Each offer the standard buying and selling, but differ on crypto assets on their platforms, respectively. Then the features such as staking, gaining interest on the crypto asset, if kept on exchange, borrowing against the crypto asset, if on exchange, using leverage, or purchasing of derivatives or synthetics. Questions coming to light. There are 4 questions in the report they try to address. Will this new financial service infrastructure create opportunities for economic growth and activities more generally? How will FSI models change? Is the regulatory structure over financial services ready for change? Will it lay the groundwork for dissemination of banks, investment managers, payment companies, and insurance. Figure 1. How do financial executives view blockchain and digital assets? 5 statements were given and the percentages shown how much they agree or disagree with the statement. Looking at the overall group, FSI Overall and FSI Pioneers, there's a distinction between them. Starting with the overall group, min and max, and the average line being added at 78%. My organization will lose an opportunity for competitive advantage if we do not adopt blockchain and digital assets was 73% for the overall group. This was the minimum. For their maximum, blockchain technology is broadly scalable and achieve mainstream adoption of 81%. The FSI overall group never falls below the percentage of the overall survey group, meaning they are in alignment with all statements in this part. The FSI group does not have much to add to the conversation. Moving on to those who are FSI pioneers. For their maximum, 97% was in the following statement. My organization will lose an opportunity for competitive advantage if we don't adopt blockchain and digital assets. The statement which FSI Pioneers has the lowest is tied with the 3. In my opinion, the one that stands out most is our business partners, suppliers, customers, and competitors are discussing or working on blockchain digital assets and or cryptocurrencies in the context to solutions or strategies. This shows all parties involved with FSI organizations are looking into the space for a competitive advantage. Mind the gap. When comparing the max to min of the overall group versus the FSI pioneers in the statement, my organization will lose the opportunity for competitive advantage if we don't adopt blockchain and digital assets, shows 24% difference. This can be seen as an opportunity for some firms, organizations, governments, or even individuals. There is either an overestimation or an underestimation occurring at this moment in time. From physical to digital, the next section touches on several areas needed for the reader. Financial institutions, their roles and services in the marketplace, custody, dollarization, barriers of entry, stand out and should be covered in more detail. Financial institutions consist of 3 generally accepted types. Depository institutions, taking and accepting deposits from users and making loans. Contractual institutions, institutions which offer insurance and or pension funds. Investment institutions, investment banks, who offer services such as underwriting and other types of financial entities managing investments. Figure 2. The future of digital assets. There is a consensus among the cohorts that digital assets will replace fiat currency in the next 5 to 10 years. The growing interest of major institutions and individuals alike, funds continue to flow into digital asset market. Page 7 report was highlighted quite extensively. We'll be moving along through it. Impact on deposits creates an important opportunity for banks and other industries that hold assets. Thus, it's hardly surprising to see that 47% of the FSI surveyed respondents said custody remains a very important role for digital assets in their respective organization, ranking as the top role. Among FSI pioneers, the figure jumped to 63%. Safe custody, too, ranks as the top concern among holding and transacting in general central bank digital currencies at 57% FSI respondents and a stunning 77% among FSI pioneers. Custody providers such as Ion, Gemini, and Custody are currently the leaders in the marketplace. Custody with proof of stake becoming the standard, FSIs will compete with exchanges or protocols that establish pools of liquidity for yield farming. Their core business will be at stake if adoption does not happen. Treasure and Ledger hardware wallets allow users to become self-banked. The other standout in this section is the new payment channels or types. The on-ramps and off-ramps for crypto assets are still being developed and built on exchange and differ in each nation. Currently, the Circle Group aims to become a new entrant into the commercial banking system. Their application is still being processed. Circle manages a stablecoin named USDC. Custody options. This diagram I built has the owner of BTC given a few different storage options. Self-custody. Cold wallets such as a Ledger hardware device or others with the option of the owner has full custody and can move the BTC to the Kraken exchange, then receive currency of their choice or swap BTC for another crypto asset, and then move this new crypto asset back to the Ledger device. but each of these transactions will cost a fee. Sub-custody, owners leaving their BTC on exchange to allow Kraken to hold the BTC in a hot wallet, meaning the owner can buy, sell, or swap the BTC much more quickly than before and avoid the fee of placing the BTC on the exchange. Sub-custody cold wallet. Kraken has an exchange will not want to hold all the funds in hot wallets and have them ready for trading at a moment's notice. They will move some to a trusted third party. For Kraken, this firm is called Ethernet Custody. It is done in the background. The owner of the BTC is not aware that his or her BTC is in a cold or hot wallet, but this is done to ensure the funds are kept secure. Thoughts. When thinking about the threats to the banking model, a crypto asset user who has more than 1 year in the space is most likely concerned about self-custody as a priority. This would directly affect depository institutions and investment institutions, being the user-powered wallets such as Ledger or Trezor allow both keeping crypto assets in a cold wallet, with certain crypto assets being able to be staked and gain interest over time. This would reduce the bank's liquidity of capital to lend or invest. As the population shifts away from traditional banking system, this could reach a dangerous level if the users reduce their deposits and elect to shift towards self-custody en masse. Dollarization. Currency substitution does not necessarily involve the use of the US dollar. There are 3 types: unofficial, semi-official, and official. Unofficial dollarization occurs when people hold much of their financial wealth in a foreign asset, even though the foreign currency is not legal tender. Legal tender means the currency is legally accepted as payments for all debts unless perhaps the parties to the payment have selected a payment in another currency. Legal tender differs from forced tender, which means people must accept the currency in a payment even if they would prefer a specific other currency. The term unofficial dollarization covers both cases where holding a foreign asset is legal and where cases it is illegal. In some countries, it is legal to hold some kinds of foreign assets, such as a dollar account with a domestic bank, but illegal to hold other kinds of foreign assets, such as a bank account abroad, unless special permission has been granted. More than a dozen countries have what we might call semi-official dollarization, or bi-monetary systems. Under semi-official dollarization, foreign currency is legal tender and may even dominate bank deposits, but plays a secondary role in domestic currency for paying things such as wages, taxes, and everyday expenses such as groceries or the electric bill. Unlike official dollarization, countries with semi-official dollarization, ones who remain central banks and other monetary authorities and corresponding latitude to conduct their own monetary policy. Official dollarization, also called full dollarization, occurs when foreign currency has exclusive or predominant status as full legal tender. That means not only does the foreign currency used for legal contracts between private parties, but governments, used in payments, even domestic currency exists. It is confined to a secondary role, such as being issued only in the form of coins, having small value. If semi-official dollarization happens with crypto assets in the near future, businesses that offer cross-border payments will have $2 trillion at risk. That amount have believed been moved around in 2020. For context, the total crypto asset market capitalization is around $2.1 trillion. These revenues will be impacted to what degree cannot be measured at this time. From my own point of view, let's do a modest 10% capture of the market in 2022. That would be about $200 billion. That would be shifted away from the FSI system. Being that BTC is the largest, we may assume that 50% of this $200 billion would enter. At the time of recording this video, BTC is valued around $921 billion. That would amount to a 20% increase in the value that could be added. These numbers, of course, are not concrete, but shed light on what could happen in the future. Crypto adoption falls into 2 parties. There is countries that find it illegal and countries that find it legal. Looking at the illegal side, countries that are notable are Russia, China, Vietnam, Bolivia, Colombia, and Ecuador. They've banned it for various reasons, such as mining, not allowing payments, use for investments, or even speculation. On the legal side, countries that are noteworthy are El Salvador, the United States, Canada, Australia, and the European Union. Each nation uses different regulations. We'll be covering one which is quite noteworthy. El Salvador, making BTC an accepted payment method of September 7th of 2021. Users of crypto assets may have more opportunities to use crypto assets in daily life. Several other nations in South America as well are considering using BTC as the currency for their respective nations. We have reports that other nations may follow this to avoid more dollarization. Barriers of adoption falls into 3 different categories: regulations, cybersecurity, and talent. On the regulatory side, regulatory risk It's stated that 7 out of the 10th group and the FSI pioneers are concerned that it will be the biggest obstacle of acceptance of digital assets. Government agencies in the USA, such as the SEC, Commodity Futures Trading Commission, the Department of Treasury, and the Federal Reserve, are looking to apply guidance focused on cybersecurity, AML, securities registration, anti-fraud, tax, and transaction reporting risks that are associated with cryptocurrencies. FSI firms must be aware that governments may decide to select one or several firms to create, distribute, and maintain their CBDC, central bank digital currency. In the US, the rollout of CBDC is led by the Federal Reserve. This agency has been in talks with the Ethereum Group to create CBDC, cutting out well-established FSI participants. Cybersecurity has two threats limited: hacks and ransomware. Overall, the groups were most worried about 70%, but the all groups considered half above 60%. When looking at hacks, there's a saying, not your keys, not your coins, can be used to describe the risk leaving crypto assets on an exchange or a protocol for staking. The Polygon network was hacked for $611 million with an exploit in the code. The hacker later returned the funds and customers have begun to get reimbursements. Hacks can be done with social engineering, software stealing passwords, key logging, SIM swapping, and many other means. Considering the launch of the first crypto asset was in January of 2009, it was not originally involved in ransomware, but picked up speed in 2013, slowly growing to its peak in 2017, with the price of BTC reaching 20K. The spike in 2019 to 2020 also is in correlation with renewed interest in crypto assets. These cases are most publicized to come to light, but they also don't include the payments for replacement equipment, speed of building new processes and protocols for security, the downtime of normal business activities. All sectors are at risk as crypto assets become more and more commonplace and begin to be part of firms' balance sheets, such as Tesla and MicroStrategy. Talent. Currently, universities are adding courses in blockchain technology, but still lag behind the bleeding edge. With these new grads having the skills to lead their own startups or work at mid to high level entry jobs at established FSI firms. These thoughts come to mind. FSI firms prefer to hire highly educated staff from prestigious universities such as Ivy Leagues. This could put them far behind those smaller, more nimble startups who don't have extensive lists for requirements to get an interview. Talent in education also plays a role in background. Founders vary from having no college education, a degree, or even a PhD in nationalities across the globe. At the start of a new industry, talent tends to be concentrated. ETH has two founders who left to create their own projects. When looking at the talent pool of the top two crypto asset founders, BTC, estimated market cap around $820 billion at the time of recording, has a founder known by the pseudonym Satoshi Nakamoto. This can be an individual or a group of people. As for Ethereum network, market cap of $360 billion, having founding members extensive list. Some of them are Valak, Charles, Galvin, Mihai, Miar, Anthony, Joseph, and Jeffrey. From that team, some have left them and decided to create their own crypto asset. Charles created Cardano, market cap of about $70 billion, and we have Galvin Woods creating two networks, the Kusama and Polkadot, one having $2.7 billion, the other having $29 billion, respectively. From digital to future of finance, this section covers two factors that are noteworthy: lending and capital formation. Let's check the polls to see how the three groups answered. Will digital assets have a great impact? Access to funding sources. FSI pioneers here stand out at 70%. Banks face fierce competition when lending in their home nations and abroad. Issuing loans always needs to be contended with a superior focus on the core credit and underwriting risks, as well as the safety and soundness concerns regarding asset lending. When looking at the chart, we notice something of a pattern. The breakdown of the countries are in different regulations in different areas of the world. Governments need to create and deploy regulations so banks can move into the crypto asset space. Chinese banks will have the most at risk with the current status of crypto asset in the nations. I would consider Japan and France in the forefront, as Japan has been heavily invested in crypto assets, and France, as being part of the EU, has taken a lead in crafting strict but clear guidelines and regulations for exchanges and individuals to follow. The U.S. has an influx. Government agencies such as the SEC suggest crypto assets should be under their surveillance, just as stocks, bonds, etc. The IRS has not made clear guidelines as for taxation. Capital formation. FSI's role has been well established in a few areas. Seed funding considered high risk, reward normally done by firms looking for a specific sector of industry that can be disrupted. For example, this would be WhatsApp, Sequoia Capital, companies on only venture investor, which turn out to be a 60 million investment to 3 billion. IPO and underwriting, allowing companies to enter the public market. This could be done with a recent listing of companies such as Snowflake with ticker Snow, Goldman Sachs, Morgan Stanley, JP Morgan, Allen & Co., Citigroup were all part of the process, helping secure $3.36 billion at IPO date at an opening price of $250 USD, peaking at $429. The current trading price is much below that. Issuance of stock. Firms that are already being traded on the stock exchange can tap the public markets for funding if needed to expand business, for example, by selling $5 billion of stock. This was a note that Tesla did for market capitalization of $598 billion. The new offer represented less than 1% of the company's value in December 8 of 2020. Crypto assets can fluctuate much more than any fiat currency at the moment, compared to assets used as collateral in normal banking systems such as property. This in turn means crypto assets must be over-collateralized to offer a loan against the underlying asset. For example, the Nexo exchange has users being able to get 50% LTV, loan-to-value, on their BTC. The amount locked up in funds in Ethereum has reached around $100 billion on different protocols. This style is nearly seamless depending on the network being used. Nexo, being an exchange, must conduct KYC as per regulations in most nations. Users' identities, names, passports, and other information will be collected. If users opt to take crypto assets off an exchange, they could enter into a lending platform such as Aave with a value of $4 billion at the time of recording and Maker $2.4 billion at the time of recording. They do offer lower rates than the most popular CAs, but they don't require KYC, meaning the user could invest with less barriers of entry in their nation they may live in, allowing people in nations with insufficient FSI infrastructure to access the outside markets. Moving over to other key points of capital formation, firms can raise money from token issuances with the aid of smart contracts and governance models. If this operated on the Ethereum network system, it would be 24/7, 365 days a year, much different than the current stock exchange system of the NYSE, JPX, and London Exchange. Exchanges all have different hours of operation due to time zones and national holidays. Also, while stocks do offer dividends, these are normally mature businesses that do. On the other hand, crypto assets have interest built in and the POS mechanisms if users decide to stake their crypto assets rather than holding them. As we reach the end of the report, the authors use this section to review quickly but hint at other concepts that are not fully detailed. They touch on these items: cybersecurity, data, crypto asset in the marketplace, CBDC and stablecoins, algorithm-driven stablecoins, enterprise-controlled coins, overview survey, movement of money, ownership, staking, and as mentioned before, cybersecurity is something FSIs worry about. The Polygon network hack occurred on August 10th. The value of money lost was $611 million. On August 17th, it was resolved with a return of most of the funds, if not 100%. This is something FSI banks need to consider because of the new vector of attack that can happen to them with this new technology. Picking winners. With over 8,000 crypto assets currently available, retail investors have too many options with too many risks. FSIs could take an ETF approach, offering crypto assets to users. Grayscale would be the best example with wide adoption at the moment. CBDC and stablecoins happen to get briefly covered, even though they have major impact to FSI. Stablecoins are central bank digital currencies. Overall survey had a 42%. FSI overall had a 43%, and FSI Pioneers had a 53%. These numbers are striking. Currently launched CBDCs are located in the Bahamas, St. Kitts and Nevis, Antigua, and Barbuda, St. Lucia, and Grenada. In the Caribbean region of the world, having small populations and being able to roll out quickly can allow these nations to take advantage of a leading role and set standards and protocols for other nations to reference. Algorithm. DAI issued by MakerDAO has a market capitalization of 6 billion plus. DAI is an ERC20 token released on the Ethereum network. The protocol used to facilitate collateral-backed loans without an intermediary. DAI is pegged to the US dollar in a 1-to-1 ratio so that DAI should always be worth 1 USD. DAI is decentralized crypto-backed stablecoin and thus maintains its USD peg by using collateral in a form of cryptocurrencies like Ethereum. Next we have Frax, market capitalization of 330 plus million. Frax project is among the first to have a stablecoin that uses the characteristics of both collateralization and algorithm models. The Frax token, the project intends to use a token as a scalable, trustable, stable, and on-chain money. Frax protocol uses two different assets, the Frax FRAX stablecoin, which is built to maintain the peg of $1, and the Frax shares FXS governance token, which is used to support the platform's various functions. Lastly, we have Amplefork, market capitalization of $100 plus million. While Amplefork is similar to Algorithmic stablecoin protocol operated on the Ethereum blockchain, it is not pegged to the US dollar. Rather than using crypto, fiat, or commodities as collateral, Amplefork adjusts its ample crypto supply every 24 hours in a process called rebasing to maintain its stable price. To understand how the algorithms like Amplefork work, a review of Tishel marginalism is a good place to start. Enterprise control codes. R3, Hyperledger, Enterprise, Ethereum Alliance, Digital Assets are firms building their own enterprise tokens. As for firms that are exploring it, MasterCard, Facebook, Walmart, IBM, and Intel have all been looking to expand their opportunities and building their own. Competitive advantage. An impressive 97% of FSI pioneers see blockchain and digital assets as another way to gain competitive advantage. How would they do so? A. Build a CBDC in a partnership with the local government. NZI Ltd built and launched the first CBDC in the Bahamas. Leverage a current network to build a wholesale CBDC. Facebook attempted to do this with Libra originally, then moved towards Dia. Since Facebook has a large social network base in the world, it will be able to leverage that and then use that in the future. Make a private digital coin. JP Morgan has been exploring this option currently and may offer such private digital coins to their users. In the next decade, FSIs will be impacted in 3 different ways. Movement of money, ownership is easy, staking and raising capital. Movement of money. With the current banking system, FSI players are able to generate profits off the fees from being a trusted third party in a trade from one user to another. In a remittance of $200, FSIs make about 6.48% based on the transfer. When looking at the world remittances, the top 10 countries in 2020, India, China, Mexico, Philippines, Egypt, Pakistan, France, Bangladesh, Germany, and Nigeria are all nations that are having money being transferred across the world. Depending which nation they're located in, these fees could add up to large sums for FSIs and could be displaced if cryptocurrencies are adopted in mass. Ownership is easy. With age, hardware, and software, users have difficulty adopting new technologies, but with the advent of hardware wallets such as Trezor and Ledger, user accessibility is increasing over time. Also, software wallets, such as provided by Coinbase and BlockFi, for example, have intuitive and easy UIs and UXs, which alleviate the fears of users over time. Stake and raising capital. Launches of new markets occur every day, and this with each an intent to displace a certain type of sector that's provided by FSI or other firms. VC funds are also investing heavily into this, with accredited investors and early adopters of crypto assets. Closing thoughts. With having read the document several times, considering the attending reader, and doing my own research to check the data, Deloitte's team is able to shine light into the FS mindset and thinking about crypto assets in the coming decade. With the report being so brief, one can assume the report was designed to guide readers to become clients of their consulting arm at the firm. Some things to note are, first, I found it lacking with the use of some names inferred in the space. No mention of Coinbase, Gemini, Bitmain, nor others. This may be for legal reasons in accordance with providing such a report to the public. Next, charts provided do not match up with numbers quoted in the report. This happens a few times in the conclusion section. I spent time looking around if I could find the missing chart, but unable to do so. Lastly, the amount of data collected was not fully used in the report. For example, CBDC sometimes will have a major impact on the FSI marketplace. Some charts that were unused in the report were figure A3 and figure A4. There was no write-up in the report, but I found them in the appendix section. I'll be making my highlighted version of the report available online per request. Simply add me on Twitter and message me directly if you'd like to have it. Well, thank you for your time and have a good day.